Okay, right. This is a really short video. This is just page 206, just to look at this question of impairment. And I'm going to do this in two ways. I'll first of all just sort of look at, if you like, what we should put through, our accounts, what we're allowed to put through, and then we'll talk about the adjustment. But just from a teaching point of view, what we should put through. So for example, if I was just looking at these guys, just forget the adjustment for now. Let's just look at what we're allowed to put through as taxable, if you like, expenses. So trade debts written off. Yes, we can, if you like, put that through as an expense because it says trade, right? It's clear. Trade debt. So 520 can be put through. Loan to former, we cannot put through any loans. Yeah, we just don't put loans through. We don't write off loans. That's not tax deductible. You can leave it in your accounts for yourself, no problem. But for taxable deductions, you cannot be deducting a loan from your profits. Sorry. So no, you can't do that. So this is deductible. Allowance for impaired receivables. So what you have here is an interesting scenario, right? Where you have, if you like, a provision, if you like, going from 900 down to 700. So in a way you have income. So what you have here is income coming in, and this is allowed. I mentioned that earlier on because we're allowed to do that in normal accounting, so you can therefore do the same thing. So we have income of £200 coming in. So this is taxable, and this is an allowable expense. Yes. Trade debts recovered. Yes, the trade debts recovered. If you like, this is, if you like, bad debts recovered, and that is income as well, and that is therefore taxable. Again, like I said, loans to suppliers written off. No, you cannot put that through. Loan to a customer recovered. No, you cannot put that through. So just from a point of view, a teaching point of view, these are the three things that you can put through your tax adjusted, to find your tax adjusted profit. Trade debts, if you like, allowance. If it had been the other way around, we'd be putting through an expense, but here we have income with a reversal of a provision. And we also have trade debts recovered, which means that in terms of adjusting, what are we going to add back? We would be adding back all the things that aren't allowed, if you like. So we're going to add back. So let's just move down the question. I mean, this is really a short video, just to look at this question. We're going to be adding back, of course, adding back the loan, because that's not deductible. And we're also going to be adding back, if you like, the other loan to a supplier. And finally, we're going to, if you like, also, when I say adding back, we're going to be, and then deducting, of course, this loan to a customer recovered, right? And so those are the three items that you have there, kind of for dealing with that scenario. Yes, adding back these loans that you had deducted, and then deducting this recovered amount because you've put it in there as income, but really it shouldn't be in there. It's not allowed. Cool, great. So that's really the end of that short video, and then we move on to a bit more theory and just talking. But I'll talk through that in the next video. Cool, great stuff. See you in the next video.